Everyone talks about the 2008 housing crash that wiped out $11 trillion in wealth. What I'm about to show you could be 10 times worse. The former chief economist at the International Monetary Fund just issued a warning that should terrify every American who owns stocks, has a 401k, or depends on their investments for retirement. She's calculating that when the AI bubble bursts, and she's not saying if, she's saying when, we could see $35 trillion in global wealth simply vanish. I'm looking at market data from December 2025 that shows this crash may already be starting. AI stocks are collapsing. Google's CEO just warned that when this bubble pops, no company is going to be immune. And here's the part that should make every taxpayer furious. The same financial instruments that destroyed the economy in 2008 are back, and they're being used to bet against the very AI companies that have inflated this bubble to unprecedented levels. Let me walk you through exactly what's happening and why 62% of Americans who own stocks are about to get crushed while Wall Street prepares to profit from the collapse they helped create. The numbers are staggering, and they're happening right now. In just the past month, AI-related stocks have lost over $2 trillion in market value. But that's just the beginning. What we're witnessing is the early stage of what could become the largest financial bubble burst in human history. And ordinary Americans are going to pay the price, while the institutions that created this mess walk away with bailout money. Here's what Gita Gopinath, the former IMF chief economist, is telling anyone who will listen. The AI investment boom has created valuations that are completely disconnected from economic reality, just like internet stocks in 19. But this time, the scale is massive. Companies are spending hundreds of billions of dollars on AI infrastructure, data centers, chips, computing power, based on promises of productivity gains that haven't materialized and may never materialize. The comparison to the dot-com bubble is frightening, but the current situation is actually much worse. During the late 1990s, AI-related investment increased the US economy by about 1.2% of GDP between 1995. The current AI boom has seen investment increases of less than 0.4% of GDP since 2022, but the valuations are exponentially higher. We're seeing much smaller real economic impacts supporting much larger financial speculation. And just like 2008, the warning signs have been flashing red for months, while everyone pretends everything is fine. Credit default swaps, the same financial weapons of mass destruction that nearly destroyed the global economy during the housing crisis, are back. But this time, they're being used to bet against AI companies that have borrowed billions to build infrastructure based on speculative future revenues. I want you to understand what credit default swaps are, because they're about to become household names again, just like they were in 2008. These are essentially insurance policies that investors buy to protect against company defaults. But here's the twisted part. You can buy these insurance policies even if you don't own the underlying debt. It's like buying fire insurance on your neighbor's house and then having a financial incentive to see it burn down. The price of insurance against AI companies defaulting on their debt has skyrocketed. CoreWeave, one of the most prominent AI infrastructure lenders, has seen the cost of insuring against their default increased by nearly 60% in just 2 months. This company started as a cryptocurrency mining operation and pivoted to lending money for AI infrastructure. Sound familiar? It should, because it's exactly the same pattern we saw with mortgage lenders in 2006. One analyst described CoreWeave and similar companies as like some of the more aggressive mortgage providers during the financial crisis, who showed up to do only ninja loans, no income, no job, no asset loans. These companies are lending billions of dollars to AI startups with no proven revenue models, no sustainable business plans, and no realistic path to profitability. But here's where it gets even more insidious. Major technology companies have been engaging in what's called round tripping, investing in their own customers to create artificial demand for their products. NVIDIA gives AI companies the money they need to buy NVIDIA's graphics processing units. Microsoft invests in AI startups that then spend that money on Microsoft's cloud services. It's a circular financing scheme that inflates revenues and creates the illusion of genuine market demand. The scale of this bubble is unprecedented. Tech companies are spending 60% of their operating cash flow on capital expenditures like data centers and chips. That's not sustainable business investment, that's speculative mania. Amazon, Google, Microsoft, Meta, and Oracle are betting their entire futures on AI technologies that may never generate the returns they're promising investors. And who's going to pay when this bubble bursts? Not the tech executives who will walk away with golden parachutes. Not the Wall Street firms that will demand taxpayer bailouts when their AI bets go bad. not the venture capitalists who will claim they were just following market trends. It's going to be ordinary Americans whose retirement accounts, pension funds, and investment portfolios are loaded with these overvalued AI stocks. Here's the devastating reality that nobody wants to discuss. About 62% of Americans own stocks, either directly or through retirement accounts. According to survey data, approximately 54% of people with incomes between $30,000 have investment accounts. These are middle-class families who have been told that investing in the stock market is the path to financial security and retirement. But the stock market they're investing in has become completely distorted by AI speculation. The top 20 companies on the S&P 500 now account for 52% of total market value, with the top 10 dominated by AI-related companies. This means that when the AI bubble bursts, it won't just affect tech stocks, it will devastate the entire market and wipe out retirement savings for millions of American families. The wealth effect that could result from an AI bubble burst would be catastrophic for the broader economy. When people feel significantly less wealthy because their investment accounts have collapsed, they stop spending money. Consumer spending has been driving the economic recovery, but if middle-class families see their retirement accounts cut in half or worse, they'll drastically reduce their consumption. This creates a vicious cycle. Reduced consumer spending leads to business failures. Business failures lead to unemployment. Unemployment leads to more people needing to liquidate their remaining investments just to survive. And when everyone tries to sell at the same time, prices collapse even further. The unemployment impact could be severe and lasting. When the internet bubble burst in 2000, unemployment increased by about 2 percentage points. When the housing bubble burst in 2008, unemployment rose by over 5 percentage points. An AI bubble burst could potentially be even worse because of how deeply AI investments have penetrated the entire economy. But unlike previous bubbles, this one has a particularly cruel twist for younger Americans and people just entering the workforce. AI technology is specifically designed to eliminate entry-level jobs and remove the lower rungs of career advancement ladders. So not only will young people see their limited investments wiped out, but they'll also face a job market where AI has eliminated many of the positions that previous generations used to build careers and wealth. The geographic impact will also be uneven and unfair. Silicon Valley, Seattle, and other tech-heavy regions will see devastating job losses when AI companies collapse. But the financial pain will be felt nationwide as pension funds, university endowments, and retirement accounts loaded with tech stocks lose value. Rural and suburban communities that never benefited from the AI boom will still pay the price when the bubble bursts. State and local governments will face budget crises as their pension obligations remain fixed while pension investments lose value. This means higher taxes and reduced services regardless of whether you personally invested in AI stocks. The international implications are equally troubling. If $35 trillion in global wealth disappears, it won't just affect American markets. European pension funds, Japanese insurance companies, and emerging market investment funds have all poured money into AI stocks. A massive wealth destruction event would create global financial instability and potentially trigger recession in multiple countries simultaneously. Here's what makes this situation particularly maddening for taxpayers. When the AI bubble bursts and major tech companies face bankruptcy, they'll demand government bailouts using the same justification we heard in 2000. They'll claim they're too big to fail and that their collapse would threaten the entire financial system. They'll point to the pension funds and retirement accounts that hold their stocks and argue that bailing them out is really about protecting ordinary Americans. But that's exactly backwards. These companies created the bubble through reckless speculation and circular financing schemes. They pushed stock prices to unsustainable levels while paying executives billions in stock-based compensation. They encouraged ordinary Americans to invest their life savings in overvalued shares. And now they want taxpayers to cover their losses when reality sets in. The Federal Reserve's response to an AI bubble burst would likely follow the same playbook as 2008, massive money printing to prop up asset prices and bailout programs for major financial institutions. But money printing creates inflation that erodes the purchasing power of everyone's savings and wages. So ordinary Americans would get hit twice, first from the bubble burst that destroys their investments, and then from the inflation that results from the bailout policies. Small businesses would face particular hardships during an AI bubble collapse. Credit would tighten as banks deal with AI-related losses. Venture capital funding would dry up. Consumer spending would decline as households deal with reduced wealth. The timing makes it even more concerning. We're heading into political and economic uncertainty. with trade policies in flux, historic debt levels, and infrastructure needs. An AI bubble burst would drain resources from addressing these critical challenges. What's particularly frustrating is that this disaster is preventable, but financial incentives encourage bubble formation. Wall Street profits from trading volume, not long-term productivity. Tech executives benefit from stock price appreciation, not sustainable business building. The regulatory response has been completely inadequate. Financial regulators seem more interested in facilitating AI development than in preventing speculative excess. Banking regulators are allowing institutions to make massive bets on AI companies without adequate capital reserves. Securities regulators are permitting the kind of circular financing arrangements that would have been questioned more aggressively after the lessons of 2008. Congressional oversight has been non-existent. Politicians give speeches about protecting families while allowing the same financial engineering that destroyed the economy in 2008 to repeat with AI companies. The Federal Deposit Insurance Corporation should examine whether banks have adequate reserves for AI-related losses. The Securities and Exchange Commission should scrutinize whether AI companies provide realistic business assessments to investors. Instead, we see regulatory capture where agencies responsible for protecting the financial system prioritize technological competitiveness over preventing disasters that taxpayers will pay for. The Federal Reserve's role in enabling this bubble has been particularly troubling. By maintaining low interest rates for extended periods and flooding the financial system with liquidity through quantitative easing, they created the conditions for speculative excess. Cheap money and abundant credit always flow toward the latest investment fad, whether that's housing in 2006 or AI companies in 2025. When interest rates are artificially low, investors desperately search for higher returns and become willing to take enormous risks. Pension fund managers who need to generate 7 or 8% annual returns to meet their obligations start investing in speculative AI startups because treasury bonds only yield 3%. Insurance companies that need steady returns to pay future claims start buying AI company bonds because they offer higher interest rates than government securities. This creates a dangerous feedback loop where low rates force institutional investors to take more risk, higher demand drives up prices, and reduced returns force even more risk-taking until the system depends on speculative investments. But here's what I want every American to understand. You don't have to be a passive victim of this financial bubble. Yes, the system is rigged against ordinary people. Yes, Wall Street will profit while Main Street suffers. Yes, the government will probably bail out the institutions while leaving individuals to deal with their losses. But knowing what's coming gives you the opportunity to position yourself defensively. This means understanding that when everyone is talking about revolutionary technology and life-changing investment opportunities, that's usually the time to be most cautious. It means recognizing that if something seems too good to be true, like AI companies with no revenue but billion-dollar valuations, it probably is. It means building financial resilience through diversification, emergency savings, and investments in real assets that maintain value during financial crises. The $35 trillion wealth destruction that Gita Gopinath is warning about isn't some distant theoretical possibility. It's the logical mathematical result of current stock market valuations meeting economic reality. When companies are valued based on speculative future AI productivity gains that haven't materialized and may never materialize, there's only one possible outcome when investors finally demand real returns. The question isn't whether the AI bubble will burst, it's whether ordinary Americans will recognize what's happening and protect themselves before it's too late. Because when $35 trillion in wealth disappears, it won't be distributed evenly. The people who created the bubble will find ways to preserve their wealth. The institutions will get bailouts. The politicians will blame external factors. But working families who trusted the system, who followed the advice to invest for their future, who believed that AI stocks represented genuine economic progress, they'll be left holding worthless shares while their retirement dreams evaporate. And then they'll be asked to pay higher taxes to fund the bailouts for the very institutions that created the disaster in the first place. This is the biggest wealth transfer in history, and it's happening right now. The only question is whether you'll be on the side that loses everything or the side that recognizes what's coming and prepares accordingly.